So welcome back to the Property Corner. Today, we're going to be looking at the latest Q1 report from PayProp. They manage 62 billion rand worth of rental payments every year, and they've got some of the best market insights as to what's happening in the residential property market. So I've had the privilege of seeing this report before it's been released to the market, and I'll be discussing it today with Andre van Rooyen to understand exactly what's happening in that rental space.
Welcome, Andre. Welcome back. And you've got some exciting news. We received this report prior to the market, and I spent the afternoon studying it. And there's some positive and exciting news coming from it. So thanks for joining us again on the Property Corner. And we're keen to hear what's happening in the rental market in South Africa.
Rowan, thank you very much. And as always, a great privilege to be part of this. Yes, so this is fresh off the press. I think actually you're the first person in public to receive a copy of our first quarter 2025 PayProp Rental Index report. Gives some great insights. I like the layout, so go and find it. I'm sure we'll share it with you, but maybe I'll unofficially call it the Property Corner version of it, because it talks to what I think is what investors are looking for. It has a nice layout and being very specific on arrears and growth and potential average rentals. So I like the layout. I hope it helps those investors that watch your show. So just to get to the highlights, obviously this is the first quarter of 2025. Our tenants in arrears have dropped. It's on 17%. Now our average rent, the national average rent, last time we spoke, cracked 9,000 rand. Now we're just over 9,100, actually exactly 9,132. That means we're in a 5.6% year-on-year rental growth. In our report, as always, we compare that with inflation. Inflation, we're at 2.7. As I mentioned, we're on 5.5% average rental. We also compare that with the rental SA Reserve Bank prime lending rate, which has gone down a couple of basis points as well. So I want to get down to the interesting stuff. But before I get there, just on the arrears, and we touched on that because arrears is probably always part of our country and challenges. The arrears we measure as a percentage of the monthly rent. So just as an example, and I mentioned this before, if your rent's 10,000 rand and a tenant is in arrears, with what percentage of his monthly rent is he in arrears? And that has gone up from the last quarter of last year. It was 74%. The first quarter of this year, it's 77.1% of the amount of rent that is in arrears. Now, I looked at this historically, and I say this because it's just typical, and it tends to peak at the beginning of every year. And I think, and I mentioned this earlier, it's because we spend too much money over December. And so we use our rent to pay for our December holidays. So just a little bit of an interesting insight. I hope that goes down. Surely the statistics show that it's going to go down. Okay, so now to get down to the bright face conversations, the highlights of what's happening in our country. So in the Eastern Cape, the year-on-year rental growth is 4.4%. That means the average rent in the Eastern Cape right now is 7,330 rand compared to 7,021 a year ago. However, remember the average arrears in SA at the moment is 17%. In the Eastern Cape, it's 19.3%. Down a little bit from last year, but still relatively high compared to the balance of the provinces. Let's look at the Free State, a good growth of 7.6%. That means the average rent is 7,454 rand, but again, the arrears 20.8%. It's down a bit from a year before. In 2024, it was around 22%. To get us to Gauteng, our beloved Gauteng, and just put a pin in Gauteng because I want to refer to Gauteng a little bit later as well. So we saw a 2.9% growth in Gauteng compared to 3.5 Q1 2024. Okay, growth has gone down. It's still over 9,000 rand, still over the average in the country, 9,201 rand, with the arrears of 15.6%. That's good news. It's a little bit under the average. Now let's have a look at KZN. Last time we spoke, we pointed out that maybe this is a province that we should look at. 4.5% year-on-year rental growth. The average rent, 9,170. Remember Gauteng, 9,201. Look at KZN now, growing faster, almost cracking the 9,200 limit as well. And then with the arrears a little bit higher, 19.4%. If we go to Limpopo has got 10.9% year-on-year growth, 8,800 average rent with 17.1% tenants in arrears. In Mpumalanga, only 1.1% growth. Average rent in Mpumalanga is around 8,400 with 20% of tenants in arrears. Now, Northwest Province, look at that great growth, 13.5% growth compared to 9.8% in 2024. That's a substantial increase in growth, with the average rent 7,100 Rand and the average 18.6% tenants in arrears. Northern Cape only seeing 3.3% growth. It's up from the 0.3% in Q1 2024. So again, good news. 9,500 Rand the average rent, and the percentage of tenants in arrears 18.9%. And then Western Cape. Western Cape is still going very well there. Year-on-year growth, 9.6%. Average rate in the Western Cape right now, 11,285 Rand. Look at those arrears numbers, 13.7%. Doing well. Now I mentioned Gauteng, and I mentioned that we now have a ranking system because things are changing, and it might be because of people moving provinces. We touched on that earlier in a conversation. Why are they moving provinces? But if we look at the rent, just Q1, average rent, Western Cape, number 1. Northern Cape, number 2. Gauteng, KZN, number 4. Now, the difference between Gauteng and KZN, Gauteng's average rent, 9,201 Rand. KZN, 9,170 Rand. I have a sneaky suspicion in our next report, we're going to have a new number 3 with the highest rent, and it's going to be KZN. Seeing some good growth in the lifestyle estates as well. So those are the highlights. We also include in our report what I think is very, very important for property investors. It's also important for property practitioners. A lot of the conversations that we have in the market right now, especially from my side with property practitioners, is that we don't want to sign contracts that break. And how do we evaluate our risk better to make sure that we're contracting with a person who can afford the rent and who's hopefully going to stay in the term that they sign up for, because that's first prize for investors, that's first prize for property practitioners. It adds stability and it adds predictability to our investment. So for this, we include a risk rating in different age categories. This is based on an Experian credit risk. It talks to affordability, it talks to credit exposure. It has quite a lot of insights compared to age groups. Just as an interesting fact, when it comes to disposable income decreases from the ages of 30 to 49. 49 disposable income is between the age group of 40 and 49. Disposable income is at its lowest, only 13.3%. And then as people go into their 50s and up until 59, it increases a little bit to 16.9, and 60 plus it goes to 27.5. So between the ages of 30 and 49, disposable income is shrinking. I think it's probably because a lot of people are buying houses at that in that age group. The credit exposure is growing. With credit exposure growing, credit risk increases, but also the sensitivity to interest rates. And all of that has an impact on my affordability, my ability to pay my rent. The question is, if I have a tenant in this age group and the interest rates are turning, and I know, and I should know, that the credit risk is high, what am I doing to mitigate my tenant risk? Do I understand that they can still afford this? Is it within my rights? Is it within the property practitioner's right to maybe do an assessment again? If a tenant defaults, when should I be doing an assessment? Our country is always proven to be very sensitive to disposable income, which is a function of the interest rate. So when it comes to risk mitigation, we have to understand the tenants that we place to make sure that we contract and we make sure that we do business with contracts that don't break, so we can accommodate happy tenants. Happy tenants pay. And those are the highlights, Rowan. I hope this helps. I hope this is something that investors can take to the market. I hope it's something property practitioners can use to mitigate risk. And as always, open for discussion. We love the industry. It looks promising, and we hope it keeps on going that way.
Cool. Thanks, Andre. Just one or two things that sort of come to mind looking through these figures. One has to ask that growth in Northwest of 13.5%. I mean, that's sort of unheard of figures. What is that? Could that simply be put down to the fact that they're coming off a low base? Some people would assume, being the lowest average rental in the country. Or is there something else brewing there too that we aren't aware of, or that we might be overlooking? Do you have any insight into why Northwest is going through such a growth spurt year on year?
So it comes as a surprise for us as well, Rowan. I hope to spend some more time in the market. I mentioned this in the conversation before. The value of a local, well-educated and well-informed property practitioner is probably going to be your answer here. The different areas and their different dynamics are hard to anticipate and are hard to evaluate in this data. But if you're going to be an investor, I'd definitely go and speak to a property practitioner and understand the dynamics, because it came as a surprise for us. And I look forward to finding out, what caused the spike in the year-on-year rental growth.
And, I think that's what a lot of these sort of reports, that's why we have them, to pick up on this historical data. But as you say, very often that practitioner at grassroots level has preempted this by experiencing it firsthand. This is 6 months. Our report is effectively 6 months after the first period that it includes. And yeah, it will be interesting to dig into some of those figures. And I'm sure we'll see more reporting covering that. Interesting thing to look out for and something to understand. One of the more disheartening figures was the disposable income being lowest between ages 30 and 49. Was that, eh?
That's right. It decreases.
So I'm right in the middle there. So
Yes.
all that I know is I've got a hard time lying ahead personally.
Yeah. So it starts at 30, and then it's at its lowest when you're about 49.
I can attest. I know exactly what. You should have just asked me.
Yes, and there are a lot of events that happen in that age group. Kids are expensive. You're buying houses and paying cars and all of that. So it sort of makes sense. Hopefully you have a partner to contribute. I think that'll help. But I think that's just typical. It's an indicator of our lifestyles and the way we go about the evolution of life. But what do we do with this information? I think is more powerful. And I mentioned earlier, if I would have tenants, if I would have landlords, working with landlords as a property practitioner, this is very insightful data that they should know, because you sort of feel it, but you don't discuss it with everybody. And so when you go, well, I've gotten a nice place. I'm renting a nice place. I'm stretching my max rental because I want to stay in a nice place. I've got the kids and I want the lifestyle. Realize that you're also at this stage in your life when you're going to have the least amount of disposable income. So should you be stretching your rent affordability really? So these type of insights, we hopefully learn from them.
And Andre, the good news that also that's come out of the report is that real rental growth is back. In most of the areas. It largely helps that the inflation in South Africa has come down, but real rental growth is back, and it's back strong. And we can see it firsthand. We can see investors coming, in higher levels than we have in the past. We can see the demand for rentals picked up. We can see escalations, those year-on-year growth figures. We can attest to them. That's what's been happening in our markets too. But exciting real rental growth is back, something that hasn't necessarily been back for most of the country. And now looking at this, I think there's one province, it's only in Mpumalanga, that would not have real rental growth?
Yep. Yeah, so the real rental growth is great news. Again, how do I apply this? And we mentioned this in a conversation earlier as well. We want to sign a contract at the right price, first of all. Get your price right, know the data. This is the rent that I want to go to market to. Now I find a tenant. Now I have a 12-month lease agreement. The rent is going in that direction, most provinces. What happens after 12 months? Am I able to have the rental increase discussion as a landlord? Am I good at this? What do I base this off of? Do I contract for it properly? Because if you're now buying and rent is in this cycle and you're not implementing rental increases when they are due based on the data that we have, you're going to fall behind and your investment is not going to show the same returns. So prepare everybody for a market that's seeing an increase in gross rentals, but also implement it accordingly, which is a tough conversation.
And it is a tough conversation for anybody to have. No one wants to be passing on costs to anybody else. You always feel, even whether it's as a practitioner or as a landlord yourself, it never feels, sort of good, to be passing on costs. But there have been real costs over the past 5 years, and landlords to a large extent have absorbed them. And as you say, just educating tenants in this market that this is also a cycle that will also pass, and it is a period of high, sort of rental growth. And as tenant, that might not be the best news, but if we put that into perspective when entering into these agreements and having these discussions and looking over a longer term, then that also provides hope to say, well, you know what, I've had this benefit for quite some time of not having real rental growth, and now I'm in the period where it is growing, and I'm probably going to be paying a bit of a price over the next cycle, but that too will come to an end. The other thing, just from an investment perspective, is your affordability ceilings. That's maybe something to understand a bit better, because there's a lot of attractive sort of growth, but the rising arrears, is something that I think you guys have touched on as well. And the question just lies is, where's that ceiling? In the Western Cape that I can relate to, there's been strong growth, but there's also been a decline in arrears. But at some point in time, that like any market, there has to come some form of a ceiling. Are there areas where you believe those ceilings are close? And do you think it is as simple as affordability versus rental growth that would create that ceiling?
Geez, so there's a lot to unpack in that question, because, and I think we touched on that as well, is it's about the stock in the market as well. How much properties do we have for rent in the same price range? And with high rental growth, and they tend to come hand in hand, comes an increase in the stock as well, because the investors are seeing this as an opportunity. You see some more stock in the market, and so the demand is catching up. The supply is catching up with the demand. So I would really start to look at new developments in the market. I guess from a developer's point of view, early to the market is always the best. Easier said than done, I know, but that'll be my taste. I must say there's some great insights. If you're going to do, and maybe I'm talking to the property practitioners now, because I think a lot of property practitioners, when it comes to evaluating a rental, where they find their information and the context, they've become much better at that, to understand if a property is lettable. Now, to give you an idea from our users, property practitioners, the average time in market spent for a rental is between 2 and 4 weeks. So if you work that back and you have new stock in the market and it's in the market for more than 4 weeks, your price is wrong. That means you've probably reached your target. That means you're pushing it a little bit too high. By the way, it's 3 to 6 months for sales property, depending what area you're in. But that's a nice indicator. So you'll put your stock in the market, you go to the market, you'll say, here's my rental at 10,000 Rand. It's over 4 weeks. You've got it wrong. So that'll be an indicator for me. The affordability tests, I'll use the age groups, I'll use the income groups. You should have insights on that when you evaluate your tenants. I'll be sensitive to interest rate increases, maybe even consumption increases, electricity and those type of things, just simply because our disposable income is so close to what we're spending on rent. That'll have an impact. So yeah, I think between all of those indicators, you should have a good answer on what the right price is, to make sure. And that's the other question: is you want the right price to attract a good tenant that stays there for a reasonable amount of time. There's a lot of boxes to tick here, and how do you get all of them tick? What's the likelihood? And maybe you should compromise on some of them. It's a tough balancing act, but we have the data, and I'm happy to say I'm very impressed with some of the property practitioners who are really good in assisting investors to get this done and making sure that they tick all of those boxes.
I think, Andre, the nice thing about your report is that it empowers landlords and property practitioners to apply a broader spectrum vetting than the traditional, sort of application-based vetting, and is maybe, when I say that, I mean you really have one point in time at which you can, sort of screen the application, but also maybe giving insights and identifying on larger portfolios, especially, applying these trends and things that you guys have picked up on where problematic areas may, sort of creep in. And especially where leases are renegotiated or simply extended, and there might not have been the due diligence in re-vetting the client at that point in time. I think everybody who is either a landlord or a practitioner has probably fell into that rut at some point in time, where a contract has simply been extended based on a tenant's good faith and good standing, rather than rescoring and sort of evaluating that tenancy. I mean, we all should be doing it. It's good practice, yeah. but this is life. These things happen. 5 years later, your tenant's been great, and run of the mill happens. The addendum is signed or an agreement is extended. I think these tools that you are putting out to market are very powerful to actually give some insights, identify these things, and just remind landlords and practitioners about the importance of checking, sort of that qualification every time that agreement is entered into again, and almost regarding it as a new agreement, and discarding, sort of the past.
Yeah, no, absolutely. And again, the conversation with the property practitioners in the market right now is you're entering into a relationship for 12 months. Okay. Now, we're very good at the first part of the relationship. We're very good at getting the contract down and collecting deposits and doing the vetting checks and reference checks and so on and so on and so on. Traditionally, we're very good at this. But in 12 months, a lot of things happen. And so we drop the ball because we are not sustaining this relationship in the 12 months. We're not communicating properly. We are not informing our tenants of trends in the areas. And by the way, I'd imagine the tenant being very curious about the trends in the area, because a lot of these tenants maybe want to buy. If you look at this from a property practitioner's point of view, maybe even from a developer's point of view, they probably want to buy. They're curious if they've been, if they're paying the right rent, if they want to stay in the area, they're planning a family. So a lot of interesting, relevant information should make the whole relationship go a little smoother. So the communication is important, talking to the data, talking to relevant stuff in the area. And then when it comes to the rental increase conversation, the groundwork's been there. The groundwork's been laid. Best practice in our industry, or not having best practice in our industry, is a big part of most of the hard phone calls that we have to have. So the hard phone calls about, why are you deducting this from my deposit? The water isn't off, but meanwhile the whole area's water is off. The list goes on and on and on and on. And I believe a lot of those bad practices contributed to the managed rental or the buy-to-let market having bad stigmas. It was badly managed before. We communicated badly before. If we don't do this, it's still a great asset to invest in. It's an opportunity for growth, that beautiful annuity income, but communicate.
Cool. Thanks for that, Andre. Maybe just back to some of the macro trends and market outlook in the report. Highest rental growth in almost 8 years. We've touched on interest rate. I just want to summarize for myself. Affordability increasing. Sort of a ratio of income versus a rent being some of the lowest in the lower end of where it's been before. Inflation, sort of figures coming out helping, interest rates dropping, affordability looking a bit better. Are there any other main drivers that I've missed? Is that the right ones to pick up on? Anything that I've missed?
You're right. The other driver, and it's hard for us. It's hard for us to anticipate, and it's hard for us to evaluate, is infrastructure development and infrastructure sustainability. Now, if you're a good investor or an informed investor, I suggest you keep an eye on that. If you're an informed property practitioner, you must keep an eye on that. I was gonna go. You sure as hell should keep an eye on it, because that is the drivers. That is the insights that your buyers want to have. That's the insights that your tenants want to have. So you'll get that. I think some of the local municipalities are better, and some are not as great with communicating that. But infrastructure is the variable. I think that's hard to anticipate.
Good. The interest rate discussions and the inflation dropping. I think while these are easy to maybe quantify, I suppose they're also hard to anticipate. With everything that's happening, not only in our local markets but also abroad. But good news, as we've touched on already, is that there's sustained real rental growth, and we hope that will hold. The tenants in arrears at 17% seems to have stabilized. Do you expect this to hold? Taking these macro factors into account, one would think so. Reading this report and looking at the influencing factors, do you expect that to hold?
Yes, I think the indicators are there. We included the graph where it was at its highest, where inflation. I have to get this just a little bit bigger. They're just catching up with me, At least my disposable income.
Yeah, your prospects for disposable income are looking better.
Okay, so as soon as inflation, and this is just a common trend, as soon as inflation was going this way, the rental growth was going this way. Yeah. So inflation went up and down a bit. It's now 2.7, and so the big divide was the downward cycle of the inflation rate, and that's it. Add to that a downward cycle in the interest rate, more money on the table. Now, I always ask myself, if inflation is down and if the interest rates are down, we should have more money. What do we do with that more money? Well, some of us take out more debt. That's just the nature of South Africans, okay? I could qualify for a bigger loan. And some of us go and rent a bigger property or buy a bigger property. And that's just the tendency in SA. So now we are maxing ourselves out. We want to find the best place for the most bang for our buck, let's call it that. But we should always tend to stretch ourselves a little bit. That means we are sensitive to these three indicators. That means we are sensitive to the interest rate. That means we are sensitive to inflation. Inflation has gone up before. Interest rates have gone up before.
And they will again.
And they will again.
I think the positive in that, Andre, is that that rent to income ratio of 28.8%, at least gives us some hope that tenants have the ability to absorb some of these escalations. The picture could have been completely different if it was purely demand supply based, and like we are seeing in some of the metros, with reporting of Cape Town CBD becoming unaffordable, and but fortunately that's localized, and we don't have that spilling over. So I think that's at least some good news for the market. Is while it might not, you might want to be spending that money on something else. The good news is at least is that rent to income ratio remains at 28.8, and that gives us some sort of hope, doesn't it? The investor and landlord perspective, we've touched on some of the vetting. we've touched on some of those rental yields, the re-vetting, but just wanting to maybe give some advice again. How can landlords future-proof their portfolios against some of these financial pressures? Have you got any tips, any advice? I know we're looking for a sort of crystal ball.
Yes.
But how can you future-proof your portfolio if you are an investor? What would be the best moves right now?
So depending on what demographic you're catering for, I'll be less and more hands-on. What I mean by that is, again, just from a sensitivity point of view, from income sensitivity point of view, if I'm catering for the more affordable market, I touched on this, but we didn't publicize this. If the 10,000 Rand and under disposable income earners, 10,000 Rand and under is about 2% disposable income. Now that's a massive rental demand market, by the way. So if you can get this right and understand the demographic, you probably won't have a shortage of applicants, of tenants, but you have to be very sensitive for their affordability.
Yeah.
And as it goes up, the affordability and the disposable income increases. And so I'll argue maybe you shouldn't be as close as you don't have to be as close to your till. But again, then we have the infrastructure to consider. So I think the traditional approach from a managed rental or an asset investment, annuity income in South Africa, because of the big difference that we have in income groups, means that we have to be closer to our till. And that's how I'll future-proof it. If I was in the market right now, I'll make sure I understand the area. I'll make sure I understand my demographic. There are many demographics to cater for, by the way. You don't just have to go for those certain demographics. Maybe it's a good idea to have a good diverse spread for the different demographics. And then I'll make sure I'm in the market. I'll make sure I have a property practitioner by my side who knows it well, keeps an eye on it. Maintenance, I'll manage my 12-month relationship well. I'll communicate well. I'll be the good landlord. So yes, it's going to be hard work, unfortunately.
I think you touched on something which is probably quite sensitive, but also encouraging. Is that the lower segments of the market where sort of your pricing is at the entry level of rental properties, as well as sort of purchase pricing. And that's a market which we've seen in the past. People are scared to enter as investors, right? Because they are uneducated as to the figures that you've mentioned. Mm-hmm. Now, I think there's a place and there's a case to be made for that market, as you say. The volumes in that market and the potential, is great. People are taking that risk and are entering that market, are seeing great rental yields. And I think, one of the practical things that one can do to mitigate that is to educate yourself. And as you say, number one, be aware of what's happening in those markets, understanding them. And if you can get that balance right between understanding the affordability constraints, the pressures that may lead to arrears in those markets, and identifying the correct tenant. From an investment point of view, it's probably one of the more attractive markets to be in, and not simply as an island, but also to balance your fund, because these are very often the areas that are seeing better rental yields when taken, when measured against capital outlay. Yeah. So, the people speak a lot about positive cash flow properties, and from an investment perspective, these are very often the cases where you can be positive from day one or very close. In terms of biggest indicators and factors, Andre, that you expect to affect the market going forward, interest rates and inflation figures going forward, would that be the two biggest things that we can maybe preemptively act upon when they do change and get an idea?
Yes, I think those are my top indicators. I'm again happy to say the bank's appetite to finance buy-to-let properties is still bullish. Okay. And I picked this up in the conversations that we have with the property practitioners. Access to finance, I guess, is always part of our market. So that's some good news. I don't know about their affordability tests these days, but it sounds like they're keen. They share our sentiment on the growth when it comes to mortgage finance. The property practitioners, however, are saying that there isn't as big a take-up for the buy-to-let buyers as they would think. So maybe there's a bit of a lag, and maybe there's some more educating the market and understanding how to go about buying to let finance, So yeah.
I think that's something where at a very local, small level, I've picked up on, and maybe this is one of those things that as a practitioner you pick up in grassroots and try and rationalize it for yourself before there's sort of large scale reporting on it. But what I've found is that a lot of our investment, buy to let investment, is coming from outside of Cape Town, as a practitioner in Cape Town. And I think there's a lot of confidence from people, number one, who have never been in Cape Town and who aren't living in Cape Town.
Yeah.
And that's not something traditionally our buy-to-let market in Cape Town would be someone who lives in Cape Town, they buy within the suburb where they live, that being close to your till sort of story, that the analogy that you were using. Because I think it brought a certain level of comfort, knowing that it's brick and mortar, it's close by, I can manage it, I can go there if need be. But I think with the performance that the Western Cape has had over the past 5 years, it's attracted not only a local market, being a provincially local market, but also from different centers in South Africa where people are saying, well, if I'm going to be buying a second residence, probably want to be doing it in the best area that I can. And as well as expats, foreigners living abroad, I mean, that's or expats living abroad, that's a big market, that we deal with. And you do think to yourself, well, if someone's sitting abroad and they say, well, I want to put some money back into South Africa, where do I want to do it? They're going through that same thought process and probably looking at the reporting and the figures and saying, well, I want to do it in the best performing area. Now, that may change. It's not to say that the Cape Town is going to be there forever, but it currently is. So I think if you speak to my business and to us as practitioners in Cape Town, I think we're seeing some of the highest levels of buy-to-let than we have in a very long time. But I can also, while looking at these figures, understand that some of the other areas might not be. So that's something where I think as a sales agency and on companies like Lightstone, sitting with that sort of information, but I think that information sitting in the bank's hands. It's going to be interesting to see how that information is reported and pans out because, I don't know. We don't know nationally are these figures buy to let up and down and what's happening regionally, but we can certainly say at the sort of micro level that we are trading at, it's some of the highest levels that we've seen.
That's brilliant news, and I will urge the local property practitioners to have a similar conversation. It's an opportunity for the property practitioner, it's an opportunity for the area, but education is going to be a big part of that. Understanding how to go about this is important and more tricky than you would think,
Yeah.
Listen to the property corner. I love your advice.
Andre, thanks. I think that brings to an end the discussions about this Q1 report, and thank you for the work that you guys do as PayProp in compiling these reports. One thinks, you sit with this data, just push it out there, but we understand that that's not what happens. There's a lot of thought and a lot of understanding that goes into putting out these reports. So thank you for that, and thank you for sharing these valuable insights, and thank you for allowing the Property Corner to be one of the first to lay eyes upon this. So thanks for that opportunity, and thanks for being available to have these discussions. And we hope to have you again with the Q2 report, and then we'll have to test some of our theories and deductions and assumptions that we've made today.
That'll be brilliant, and thank you for the opportunity. I appreciate your work, and let's hope the market keeps on growing.